Hello, everyone. My name is Tina Shackman. I'm on the board of directors of the CFA Society of Orange County. Thank you all for joining us today. We're pleased to have an in-person event. It's nice to re-enter society. So excited for this. We are going to be talking about the great reopening. We have some folks from First Trust here with us. I am going to turn it over to Craig Pierce, and he's going to introduce our speaker.
Okay, thank you very much. First, I want to quickly address the room and just remind everybody to the CFA, CFPs, advisors that you are in a noble business that's incredibly challenging, probably going to get tougher. And First Trust is privileged to work with you and be a resource for you in any way we can. Before I introduce Strider, I want to point out my colleagues in the back of the room. Jeff Baker, give a wave. Jeff is our Orange County ETF specialist. To his right is Sam Frasco, Orange County Unit Trust. And on the other side is Matt Phillips, structured note, target outcome ETF, options-based specialist. They put that all on one business card. That's hard to believe. If you haven't already, please introduce yourself to him. We would appreciate that. Strider Elass, senior economist at First Trust, student of Brian Westbury. And together with Bob Stein, this is the First Trust economics team. And this is the greatest economics team of all time. And let me explain. And I'll take you back to 1999. Brian Westbury and his capitalized profits model said the market was 60% overvalued. 2008, Strider and the team was begging regulators to reverse mark-to-market accounting, calling them. On TV, they were calling Brian mark-to-market accounting Brian. Here he comes again with his silly mark-to-market accounting. And what happened on March 9th, 2009? They reversed mark-to-market accounting. The stock market bottom ticked, and the team called for a V-shaped recovery and then a plow horse economy, and was saying that the stock market was consistently and considerably undervalued to this day, with a very steady hand, I might add. March 2020, last one. The government experts and intellectuals came out and said, we've crunched the numbers and we need to shut down the economy. What do you mean shut down the economy? Everyone's got to stay at home. For how long? Could be 15 days, could be 2 years. We're not really sure yet. Strider and the team, they said, wait a second. This math you're showing is off by a decimal point. This is the decimal point that changed the world. And you can look that up on Google. So it's my great honor to introduce Strider to this room and virtual room of exceptional people. Appreciate it.
Well, we're going to get started. I've got a few questions to ask Strider, and then we'll open it up to the audience. This is a nice, intimate group, so want to make sure you all have an opportunity to ask Strider some questions. So I think the first thing, obviously, the last 18 months, we've been going through a pandemic, and it's really wreaked havoc on the U.S. and the rest of the world. So can you share some of your thoughts on, what's happened and, where are we from an economic perspective going forward?
Sure. Yeah. When I think about what we've had to deal with over the last 18 months, obviously it's been significant. And I think where we are today, in terms of monetary policy being the easiest it's ever been, fiscal policy really being the easiest it's ever been, corporate profits at record all-time highs, interest rates very low. I think a lot of this has really been caused because of the pandemic. But I'd say it's not really just the pandemic, but it's the fear that's come from the pandemic. And the way I look at it is not only going through this pandemic, but this has really been the world's first ever social media pandemic. And we've seen fear spread in a way that we've never experienced before. So because of this, we had these drastic and historically unprecedented lockdowns of the economy, and they're really accepted with little question. And so for me, I think it's really important to be able to distinguish between fear versus danger, because just because something's scary doesn't necessarily mean it's dangerous. And just because something's dangerous doesn't necessarily mean it's scary. An example I always use is I live in San Diego now. I'm from Chicago, but every time I go into that ocean, I think about sharks. My fear is very, very high. And when you think about fear, fear is an emotion. It's the risk that we perceive. And as an emotion, it's often blind to the facts. Where you think about danger, the chance of dying from a shark attack, it's measurable, is very, very low. And yet my fear can be very high. And so for me, what I think's really been going on is there's 4 different ways you can look at the difference between fear and danger. Death by shark attack for me falls right here into this upper left-hand quadrant. It's something that's very scary, but just not that dangerous. And yet, when I look at COVID-19, I'd say for the majority of population, it also falls into this upper left-hand quadrant. And the reason I say that is because the data has been very clear from early on. What we've known is that those 65 plus with pre-existing conditions, those are the ones that are most at risk by a long shot of being impacted significantly from COVID-19 in terms of dying. In fact, if you look at those 85 plus, it makes up that's 1.8% of our population, those that are 85 years and older, and yet they've accounted for a little bit over 25% of all COVID-19 deaths to date. You look at those 65 plus, it's only about 16.5% of our population. And yet they've accounted for 80% of COVID-19 deaths. And so we've known who needs protecting. And yet we had these blanketed shutdowns on the economy, which impacted everybody to a drastic measure. In fact, you look at those that are 0 to 17 years old, there's been a little bit over 500 total deaths nationwide from that age category. And yet they make up almost a quarter of all population. And yet you think about everything that's happened in that age category, school closures and everything else, and how it's really impacted those on the lower income spectrum who have not been able to get the help that they've needed in a big way over the last year and a half. And it's caused even more, I would say, inequality than we've already had, if that's something that you worried about. So all this to say, I think what's really been going on over the last year is that we have taken so many resources away from areas that are less scary but more dangerous, and we've shifted them to this area that's more scary but less dangerous. And this misallocation of resources today, I think, is what we're living through and will be living through for quite some time moving forward here.
Yeah. Yeah. And I think, when you think about fear, I think about the consumer. So early on, we had, hoarding,
Yeah,
we had
sure.
shortage of toilet paper. And we really had that path of the consumer where we pulled back. Now you had a lot of stimulus come in. You had savings rates that went up and now they came right back down. So, when we kind of think about where we are right now, debt's gone back up, savings rates down, does any of this worry you?
Yeah, it as of now, it doesn't. In fact, when I look at the consumer today, the consumer is really in the best position that they have been in decades. And the reason I say that is I think I have some charts here. But when you take a look, we lost, this is employment. This is the same chart here as here. This is the 2-month period from March and April. And over that 2-month period of March and April, we lost over 20 million jobs. We've never seen anything like that before. Good news is we've added back a little bit over 17 million of those, and I think we'll see some more job gains here. But when you take a look at the consumer, here's where we were. And then we had the massive recession with the shutdowns, record high consumption in February. Here's March and April. It just fell off a cliff. But what many people don't realize is while we were going through that recession in March and April, we actually saw personal income hit record all-time highs. In fact, it grew at that point by the most that we had ever seen on record over that 2-month period, while consumption fell by the most that we've ever seen over a 2-month period. And so what we had was really low consumption, very, very high personal incomes. And so we saw essentially personal savings rates absolutely skyrocket. And they got up to about 35% over that period of time. Well, you look back to 2000, we've averaged right around 6%. We're still elevated around 10%. It's come down, but I would say all this excess savings that we've seen here, yes, some of it probably was on purpose, but I think majority of that excess savings that we're seeing will be put back into the economy through spending. And I think a lot of that is coming out on the service side of the economy as things continue to open up more and more moving forward here. But it is true when you look at the consumer in general, here's household debt, sitting at record all-time highs. And a lot of people worry. Here we were back in, running up to 2008, and household debt was at record highs. And then after the crisis we went through, it came back down some, and now it's really ramped up a lot. And so people look at household debt and they say, well, this is a big concern. But when we take out debt, usually we're not just taking out debt for no reason, we're purchasing assets. And so I think a really important measure to look at is household debt relative to household assets. And when you look at debt to assets, it shows you a completely different picture. In fact, the consumer's in one of the best positions that they've really ever been in, at least going back to 1980s, even further back than 1970s. But this is a stock measure. You're looking at just a point in time. What really matters is the flows. Can you continue to pay all those interest payments on all the debt outstanding? And so there's a thing called the financial obligations ratio. And basically what this looks at is all of your monthly debt obligations as a share of disposable personal income. And so it looks at mortgages, student loans, auto loans, credit cards, personal loans, anything you have a monthly debt obligation to. And it even includes rentals, and it includes property taxes in this measure too. And so you can see going really from 2000 on, it just continued to move higher. And so I'd say that, yeah, the consumer was over levered, but you look at where we are today, it's at some of the lowest levels that we've seen since at least the 1980s when this measure was originally started. So all this to say, the consumer today, I think, is in one of the best positions they have been in a very, very long time. And I expect that to continue here moving forward.
Okay. Well, then how would you fit in, our inflationary situation that we're currently in right now? We've kind of got this, this perfect storm of this labor shortage that's creating these global supply chain, disruptions. So when you see these high inflation numbers, I think we go back to this fear issue. Sure. Where consumers are now concerned, their purchasing power is being deteriorated.
Sure. And I don't disagree with that. I think it is a concern moving forward here. And I think all of this has been caused because of the way that we handled the pandemic by shutting down the economy. It seemed like it was going to be, it's almost like the government looked at it and said, this is like the economy is like a light switch. All you have to do is, we're going to flip it off for a couple of weeks and turn into longer than that, but we'll flip it back on at some point and everything will go back to normal. But over that period of time, we lost millions of small businesses and 20 million jobs. And they just don't flip back on like that. And on the same time, we added so much stimulus to the economy, which has caused massive demand, while at the same time, we have a lack of supply. And so I think the pricing mechanism in the economy from a free market perspective has been destroyed for the time being because of all the extra government intervention that we've seen. And so I do believe that inflation is something that we need to worry about moving forward here. In fact, when I look at inflation, I think I'll come back to this later, but let me move forward here to inflation. When I look at inflation and I look at what we have seen here, it's like nothing we've ever seen before in history with what the Fed's been able to do. Everybody could see that recession coming, including the Fed. And so the Fed tried to get ahead of it, cut interest rates to zero, provided liquidity to basically any sector that needed it, and at the same time embarked on quantitative easing 4. And when you look at what's been going on over the last 10, 15 years, when you think back to what we have seen with quantitative easing, the first 3 programs, this blue line here, that's essentially the Federal Reserve's balance sheet. And you can see here's QE1, here's QE2, QE3, then we were tapering, and then the balance sheet was declining, and here's QE4 right here. And if you followed us over the years, you know that we did not believe that quantitative easing really had much of an impact on the market or the economy the first 3 rounds, because that money was not seeing the light of day in the economy. How do we know that? Well, you look at M2 money supply, this orange line here, just continued to grow right around the same pace we've seen really since 1995, right around 6%. We didn't see a massive spike like we should have seen if that money was getting into the economy. And so why was that? Well, essentially what the government was doing, what the Fed was doing, was buying up mortgage-backed securities and treasuries from banks and in turn crediting banks with those reserves. Now, banks had the option to lend those reserves out into the system, or they said, hey, if you want, you can hold this on our balance sheet. The Fed said that, and you can earn excess interest on those reserves. And so that's what they decided to do. We didn't see this big increase in M2, but yet when you look at QE4, I would say that yes, quantitative easing 4 has been a very inflationary, and it's raising asset prices across the board and raising growth in the economy because that money is seeing the light of day. In fact, when you look, here's just a closer picture just of M2 money supply. Here's that 6% a year line right here. And over the last year and a half, really since February of last year, M2 money supply is up 34%. We have never seen growth in M2 like we have seen over the last year and a half in history. And on top of that, from a fiscal perspective, you look at government spending, that's that blue line right there. It is absolutely skyrocketing. That orange line, that's revenues coming in. The difference between those two lines, obviously, is the deficit. And government spending as a share of GDP right now is about 36%. Revenues as a share of GDP right now are about 17.5% of GDP. If you go back over history, say, take it back to post-World War II, 1950, revenues on average have been about 17.5% of GDP, while spending's been about 19.5%. So the reason we always have deficits is because spending on average has always been higher than revenues on average. But when you look at where we are today, revenues are at their historical average. And that, you think about all the different tax rates that have taken place over that period of time. I mean, we had top marginal rates in the 90s at some point over that period of time. And yet still revenues have come in always right around 17.5%. It really doesn't matter what you tax people. That's basically what you're going to get. And so if we ever want a balanced budget, what we have to do is get spending down. And so for me, I'd say the issue is not a revenue issue whatsoever. It's a spending issue. And we're going to have trillion-dollar deficits moving forward for quite some time. But all this to say, we are floating on a sea of liquidity here in the United States because of fiscal and monetary policy like we have never seen before in history. And I think this is what's leading to too much money chasing too few goods. As Milton Friedman said, it's higher inflation. And that's exactly what I believe we're seeing today. I do not believe that this is all just going to be transitory like the Fed says.
Okay, so if that's the case and we stick with that, is there a concern for stagflation? We've been hearing a lot about, this has been coming up now recently as well.
I think it is a possibility over the longer term. I think in the short term here over the next couple of years, things should still be okay. I'm not worried. I mean, if you think back to the 1970s when we had stagflation, we actually saw the economy contracting over that period of time, high employment plus unemployment, plus we had a big increase in inflation, obviously. What I think we're going to see going forward here over the next couple of years is we're going to see higher inflation, not double digit, but I think we could see 5-6% inflation for a couple of years. And I think we'll see growth, not negative at all, but I think it will slow down from where we currently are. But I think unemployment will continue to improve. Just to get back, I mean, we still have a lot of jobs to create just to get back to where we were in February of last year. I mean, we've got about 5 million just to get back there, not to mention the couple million jobs that we've missed out on since where we would have been if we didn't go through what we went through last year. So all this to say, I think we will see unemployment continue to fall. We'll probably hit an unemployment rate sub 4% some point mid next year. But I think we're playing a dangerous game with inflation. And I think the Fed is really behind the curve, even though they say they're not. And the way that I look at this is kind of here. If you look at predictions of the Fed right now, let me just pull this whole thing up right now. If you look at the predictions of the Fed, where they believe interest rates should be, or where they believe where they believe inflation will be by the end of 2021. This goes back to their meeting in June 2020 from the dot plot. And in June 2020, if you think back, inflation wasn't an issue whatsoever. In fact, we're still in the midst of that huge decline that we saw in GDP. And so they're forecasting by the end of 2021 that inflation would be running about 1.6% year over year. By September, they upped it to 1.8. By December, they upped it to still under 2%. And at this point was when inflation was starting to pick up. By the time we get here, by March of earlier this year, this is when they start to really talk about how this issue is transitory. We have supply chain issues, but don't worry. And this, you could see, they said it's going to be a little higher than we thought, but inflation is going to be back down to around 2.4%. By the next meeting here, by the June meeting, they've upped it now to 3.4%. And they said, don't worry, nothing's changed. It's all transitory. Trust us. Well, by the September meeting, the last meeting where they had a dot plot, they've now upped it to 4.2%. And at that point, they're saying the same thing. Really trust us. This is all just transitory. It's temporary. 4.2% was their forecast for the end of this year now, year over year. And this is still going to be too low. And when you think about the Fed meeting that we just listened to yesterday, and you think about Chairman Powell's comments, I mean, he basically came out and said that everybody has a different definition of transitory. There's no correct definition of transitory. And to me, that tells me that the Fed does not know what they're doing. And so if you look at their forecasts really over the next couple of years, they're forecasting inflation to get really back down to basically 2% again. I think they're going to be way off here, just as they're way off on this forecast. If you go just from December, they're forecasting 1.8%, moving all the way up to 4.2%. And not changing their opinion that this is all just transitory is sort of ridiculous to me. And he said over and over again that no macroeconomics group was forecasting this inflation. It all just came out of nowhere. Well, it was obvious. And I mean, we've got it recorded for us and many other economists that when you raise the money supply by that big, it's going to show up in prices. And I think that's exactly what we've seen. So that to us is a big fear moving forward, and a reason that I think commodities will continue to be a very good performer over the coming years. I wouldn't just look at gold or silver or oil, but I think a broad basket of commodities is where you really need to be moving forward here. Any hard assets in general, I think will still do very, very well, as I think inflation's here for quite some time.
Well, then let's switch gears. We've been focusing a lot on inflation here, but let's switch gears and go over to China. And the reason is I want to talk a little bit about the global supply chain. Some podcasts that I've been listening to have been talking about how they've got a zero tolerance when it comes to COVID. So when ships are landing there, they're having to quarantine. There's delays there. I mean, how do we see the world working through this supply chain disruption?
Yeah, it's going to be tough. And I think it's going to take a long time for this to really work its way out. And that's one reason why I don't believe, even if the Fed believes these supply chain issues are going to be over soon, I just don't see it as likely, because not only is it China, but a lot of these Southeast Asian countries have been impacted dramatically. Some of these countries that had really not seen COVID the first time around, that are now just being hit for the first time with COVID-19 with the Delta variant. And so they took from the playbooks of what most other countries did, and they just shut down completely. And so you look at suppliers like Nike and Skechers and Steve Madden, a lot of those shoe companies have a lot of their production in areas like Thailand. And they've literally seen their production decline by 80% in some of those cases. And so in general, it's going to be very, very tough to get supply in the United States when your manufacturing's just been shut down. Inventories are getting leaner and leaner, and it's really hard to rebuild those inventories for a lot of companies right now. And you look just at the Port of Los Angeles right now. I mean, we've got there's 34 ships that are still there with the average wait time of 14.1 days to be unloaded. That's unheard of, really. And it's gotten worse as time's gone on, not better. And so I think what everybody's realized here, I'm hoping they realize, is just how fragile the free market is, that there's so many different players, millions of different people that are touching every single product, that even if you have one of those million pieces that is out of whack, it can really destroy a full supply chain, especially when we've moved so much to just in time for almost everything. And so I think there will be changes that are made, but I think what's really important here is to realize that the free market is just unbelievably valuable. And I think that's what's been taken for granted for so long. And I think that's the reason we did shut down the economy, because it just seemed like everything's so easy here that, hey, we'll shut it down and then don't worry, everybody take a little vacation and then things will go right back to normal. Well, it just doesn't work like that, because there's millions of decisions that are being made every single day on products and everything. And there's so many different hands that have a say in those products. And so
Right.
that's the real tragedy, I think, that, and hopefully it never happens like that again, but it will take time to work through those issues for sure.
Yeah, and I know larger companies are hiring their own ships
Sure.
and
Yeah.
containers and bringing things into smaller ports. And so they're finding ways to navigate it, but certainly not going to be happening for everyone. If we stick with China, I think one of the things that spooked the markets a little while ago was more regulation on some tech companies. We see their president really focusing a little bit more on maybe not making as big of a profit for companies there. So, what do we see kind of coming out of China in the coming years, and how might that impact the U.S. economy?
Yeah, I think that's a really good question, because I think everybody looks at China very similar to the way they looked at Japan back in the 80s, essentially, where Japan was this up and coming country and they're going to take over the United States and everything was going to turn Japanese. And then all of a sudden Japan peaked, and yet the United States continued to grow and prosper in the 90s. And so I think the same is true today. A lot of people are worried that if China kind of peaks and starts to decline, that's going to have a massive impact on the United States. And I think China's making a massive mistake right now, because you look at why is China, the last 25 years has been incredible growth in China. They've averaged about 9% real GDP growth, whether that's real or not, who knows? But that's what they've averaged. And no country has ever seen growth like that in history. And so what are the Chinese doing right? Well, I think it comes down to really two things. Number one, China did nothing for thousands of years. Number two, they borrowed everybody's technology stole it over the last 25 years. And when you go from doing nothing for thousands of years to all of a sudden embracing capitalism, it makes a massive difference. And I think that's exactly what we've seen. Now, what's been fascinating is I think over the last 25 years, we've seen this massive growth, and it's not been pure free market in China by any means, but a lot more free market than they've ever seen before. And I think what's going on now is President Xi's realized that, okay, the free market is allowing a lot more choice, and it's allowing us a lot less control. And so we want to nip this in the bud. We want to have more centralized control. And so what are we going to do? We're going to go out to all the industries and basically start cracking down. So they started with technology. Those tech companies over the last 10 years, especially, have exploded higher and become some of the biggest companies in the world, which means they have a lot of power. Well, he came out, and Financial wanted to do it would have been the world's biggest IPO. He said, no, we're not allowing that. On top of that, he started to regulate a lot of these tech companies, and we saw their valuations really within a matter of weeks fall by really trillions of dollars. And then he started to move into private tutoring. Private tutoring was becoming this big segment in China, and he said, no, we don't want any of that. So basically they just changed a regulation overnight, and it killed that entire industry.
We turned it into a nonprofit.
Yeah, which is run by the state essentially. And then on top of that, you think about what's happened with real estate, and we've heard about Evergrande and how they're going under, and China, 70% of Chinese assets, personal assets for people, are in real estate. It's kind of amazing when you think about it. And so they've had this massive real estate boom, but now it's come to a point where some of these companies have grown so big that they want more state control. And so for me, looking at China as an investment right now, any place that you could go where a higher authority can come in and overnight basically destroy an entire industry is very concerning to me. But I think what's more concerning to China is that they don't realize it's not because they're communist that they've exploded in growth over the last 30 years. They've done it in spite of that. and it's because of the free market. And so if they want to start moving more towards a closed economy, centralized planned economy, I think you're going to see growth slow dramatically in China in the future. And a lot of the ideas are going to move out of China and into other areas where they're actually treated well, and that people can actually thrive and profit from that. And so I think the Chinese outlook, if they keep down the same path, is not great right now. And is that going to impact the United States in a big way? I think it'll have some impact. But when you look at it's kind of interesting. For the S&P, only about 2% of revenue for the S&P 500 comes from China. That's it, 2%. It's a lot lower than I would have expected, but just 2%. And when you look at, Chinese properties, are we tied up? Is this going to be another crisis like we had in 2008, 2009? Because obviously the Chinese property market is massive and it's been a bubble, but very few, especially any major financial institution in the United States, has almost zero exposure to any type of Chinese real estate. And so I don't believe this is a contagion, a bubble or whatnot. And it was really, a month ago or whenever it was,
Right.
when the correction started to take place in the United States, or the 5% sell-off, and it was due, kind of started off with China, and that if this happens to China, it's going to spread everywhere. And yet they're still going through these issues. There's defaults happening frequently now on a lot of these different real estate companies, and yet we're continuing to plug higher. And so I don't think it's going to be a contagion issue whatsoever. Maybe somewhat in China, but the United States will skirt through it okay.
Yeah, I would have thought we would have been a little bit more connected because we've got so many large, corporations in this country that are looking to the Chinese consumer.
Sure.
It's
Yeah, and it's
a lot
huge,
there.
yeah,
So it's a big
it's a massive market, and that's the thing is it's kind of always been the opposite, and I think that's what's interesting is everybody thinks if China sneezes, then the world's going to catch a cold, but it's really the opposite way. If the United States sneezes, then the world catches a cold. What matters in the what we do in the United States, we're the world's biggest consumer by far, and so we import an unbelievable amount of goods and services on a monthly basis, and right now consumption obviously is through the roof, and so if we slow down in a meaningful way, it'll affect the world in a tremendous way. But if China slows down at this point, it doesn't have as much impact, especially in the United States.
Yeah, well, that's good to hear, and I think the market's kind of filtered that out a little bit. And if we talk, if we think about the markets right now, we're at all-time highs. We just hit a record. We just hit the Dow 36,000. They talked about that years ago.
Finally.
So where do you think, if we're at these all-time highs, and Craig kind of alluded to it in his intro that, there's still a lot of upside, opportunity, but where do you think we could see a bubble?
Yeah, that's a great question. I think there are. And I don't, it's hard to know if it's a bubble or not, but I think there's a lot of areas that are very overvalued right now, not just in the stock market, but you look at the crypto space especially. And I bring that up because I do believe that we're transitioning to a new era of technology through Web 3.0, which will be a lot of the internet will be driven by different crypto technologies and non-fungible tokens. And what it allows is it basically allows anybody to be able to take their talents and put them on the internet and get paid for it, whether you want to buy somebody's crypto or not. But at the same time, I kind of liken it to 99. You think about the technology that came out over that 5-10 year period there with the internet. It's like nothing we've ever seen before, and it's allowed for unbelievable growth and new companies to come out of that. And I think, but was that a bubble? Yeah, it was a bubble. If you bought 100 companies, maybe one company made it through and it flourished and it's become the next great thing, while those 99 went away. And I think that's what we're seeing with crypto right now. Is there's this huge excitement with everything that's going on, especially from kind of the younger generation. And I think there's been a lot of people that have put a lot of money into crypto, and they've just seen it go up and up and up, and they've never lived through a massive bear market. And so I think some of these things are going to go to zero at some point, but I do believe that crypto's here to stay and that some of them are going to do very, very well. And that's a real challenge. And I think the companies that are going to absolutely flourish off of crypto or in Web 3.0 probably haven't even been created yet. And so are we late to the game to get into crypto? I don't think so. I think it's still maybe in the first inning, but I do believe this technology is going to lead to massive things in the future. But that's an area that I think is a bubble to some degree right now. The stock market in general, what's so different right now, even though we're at record highs, and I'd say that PEs are maybe stretched to some degree relative to history, but interest rates are still very, very low. Why this isn't like 1999 is that all those tech companies today have massive profits. In fact, when you look at corporate profits right now for the S&P 500, third quarter, we've had a little over 400 companies that have reported 82.2% have beat their earnings estimates. And earnings at the beginning of this quarter, it was estimated they're going to grow by about 28% for Q3, which is massive. They're currently growing at about 40.1%, which is just, I mean, these earnings have been astronomical. And so when we look at the market in general, we use a capitalized profits model, which Craig alluded to a little bit. And what we look at, it's not a very complicated model, but it's done very well over history of forecasting if the market's over or undervalued. And basically what we do is we go back over history all the way back to 1960, and we look at every single quarter, and we look at where corporate profits were back then relative to where the S&P 500 is. And then as our discount in the model, we use the 10-year treasury. We run that out from 1960 all the way where we are today. And so basically today what we do is say corporate profits based on where they are today relative to where corporate profits have been over history, and with a discount rate of whatever the 10-year treasury is, what does that output say that the S&P should be worth relative to how that relationship's held over history? And what it says today is that the market is significantly undervalued. But the reason is because the discount rate that we're using is the 10-year treasury, and the 10-year treasury is at around 1.6%. And so we don't believe that the 10-year treasury is going to stay at 1.6%. So we put in currently around a 2% 10-year treasury. And that still says that the market's significantly undervalued for fair value relative to where corporate profits currently are. And again, we only have corporate profits right now. We use economy-wide corporate profits in the model, which come out with the GDP report. So we only have really corporate profits through the second quarter right now. It says that fair value for the S&P 500 is around 6,000. Now, we don't believe that right now, and obviously there's part art, part science. Our end of the year forecast is 5,000, but what it tells us is even if interest rates go up substantially, basically to get to fair value right now, we need to see a 10-year treasury of around 2.7, 2.8%. And that's if earnings were flat, they weren't growing, and obviously earnings are still growing. And so we think there's still a lot of room for this market to run moving forward here, because what's really been driving the growth, we believe, is earnings. And even if interest rates move up, earnings power has still been very, very strong. We expect a decent year for earnings in 2023 as well, or 2022 as well.
Okay, so corporate earnings, optimistic.
Yeah, definitely very optimistic.
Okay.
Yeah.
So what would be, if we were to think about kind of on a macro basis, what would be something that might be worrying you that we may not be thinking about?
Yeah, I think the biggest worry right now for me is if there's some other, I just feel like we've really backed ourselves into a corner, not we, but I think the government in general has really backed themselves into a corner with the vaccine, and with saying that, the vaccine, the data is very clear. It's definitely helps. If you get COVID after you've been vaccinated, the symptoms seem to be a lot less severe, a lot less likely to go to the hospital. So I think it's definitely working, but I think the way they've really structured it is, hey, you have to get this, because if you get the vaccination, you're going to not get COVID. It's they almost make it seem like it's 100% effective. And yet we see breakthrough cases all the time with the vaccination, and forcing that on people, I think, is concerning. But I think the bigger issue is that I don't think people are thinking about. I think it's small, but if there is another pandemic or another wave of this that breaks out, and they've kind of put all their eggs in one basket saying that, no, this is what's going to work, I think that could have a really negative impact on the market. Obviously, you can't forecast that, and it seems like we've made it through, but I think people have moved on a lot from this, and a lot of it's going to depend on government reaction to that. And if they overreact, that's the concern for me.
Yeah, 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 I would agree with that. So last question. So we just had a big election in Virginia. So do you anticipate there might be any kind of political shifts? I think right now I'm hearing kind of inflation seems to be a political card being played. So,
Yeah.
Where might we see some of this play out even with midterm elections?
Sure. Yeah. I think it's going, if they can't if the Democrats can't get spending bills through anytime soon here, I think it's going to be very hard to get them through into next year, because the midterms will be right around the corner. And I think what was shown in Virginia is that people want to have choice again. And on top of that, I think it's going to be very hard for Democrats to really be able to hold on to the Senate here moving forward. And so going into elections with, if they wait too long to say, hey, we're gonna raise taxes on all of you people, I think is going to be a big negative, and that's not going to work out well. And so I think the market is discounted. Basically, they've priced in right now that there's going to be tax hikes, but I think there's a chance that we actually don't see any tax hikes for a long period of time. And if that happens, I think that'll take the market up another leg higher. You think about when President Obama came into office back in 2009, he had the exact same kind of slogan: higher taxes, more regulation for on the rich. And yet it took him 3 years. He had a lot more seats in the Senate, and yet it took him 3 years to raise taxes. And a big part of that was because there's enough Democrats that balked at the idea of raising taxes so early into recovery. And we're pretty early into recovery right now. And I think there's going to be enough Democrats that can hold tough here. And then once the midterms elections happen, if that does get through, I think it's going to be almost impossible. And to me, I think we're going to have a period of time after the midterms where if they do go Republican, that we just see a lot of bickering and nothing gets done. And for me, that's the best type of government, where really nothing gets done. There's nothing positive. There's nothing negative. They just don't grow. That's what I'm hoping for anyway. So we'll see.
Interesting take. All right. Well, thank you.
Yeah, sure.
Well, I'll open it up. Does anyone have any questions for Strider?
Yes.
Okay.
I'm curious, where do you see demographics playing into your long-term outlook on global growth? Obviously, kind of outside of Africa, all of the developed world, you're seeing this declining birth replacement rate, and the pandemic kind of forced the exit of so many folks that are probably not going to return. How do you see that kind of play into your long-term outlook?
Sure. So I think it really depends on where globally you are. If you look at places like Japan, their working age population has been turned off, and it's been declining for really the last 2 decades here. China's just getting to a point where their working age population is going to start declining as well. And so that's another reason why I think it's going to be very tough. In the United States, our working age population is still growing and is set to grow over the next 50 years, not at super rapid rates, but the biggest section of our population right now is those between the ages of 25 and 35. And so I think what's good about that is those people are really just moving into their prime working years over the next 10 to 15 years. And so I think that bodes very well for real estate moving forward and for anything else. But the older demographic in the United States, a lot of them that could still work have looked towards falling out of the workforce and they're retiring, or they're not going back. And so I think that's part of what we're seeing today. And I think it is a problem. We've got 10 million unfilled jobs right now. Labor force participation is very low. And there's a lot of people that are just deciding not to come back. And so I don't know it's kind of hard to figure it out from as an economist right now, because there are a lot of factors that could be at play still right now that we're just not clear about yet. So one of those factors, I think, is with COVID is even when you think about schools today, most schools are open, but if you have say you're a student and you go in and you're sick and you get a test and you're COVID positive, well, now you have to stay at home for 2 weeks and you have to. And so all of a sudden, if you have a young child, it makes it very, very hard for you to be able to work in an environment where if you need to be at work, where you have to take a chance of your kid not being able to go to school or a school shutting down if enough kids get there. And so I think that's part of it. And then also, if you look at unemployment benefits from a federal perspective, they ended in the last half of the states at the beginning of September. And so we had the September employment report already, which we thought was going to be a lot bigger than it was. It was a pretty, I mean, it was an okay report, but from expectations, it missed by a large amount. We only added about 200,000 jobs. But when you look at how the employment report's calculated, it really only goes out for 2 weeks. They take whatever the measures that they're getting within that second week, and then they extrapolate it out basically for the rest of the month. And so that's why you see pretty substantial revisions sometimes to previous months. And so they really didn't collect too much of the data from those that maybe were starting to come back to work because of those expired unemployment benefits. And so for me, I think this October report that we're getting here on Friday, I think is going to be very, very key to showing are we adding a substantial amount of jobs again? Are people coming off the sidelines or not? If not, then I think there is probably more of something broken there. As I showed earlier, savings rates went through the roof over this period of time. And so if a lot of individuals were able to save a lot of the stimulus money that was coming in or invest it wisely, put in crypto or whatever, if they made a good amount of money on that, I think that could be keeping some people from coming back into the labor force right now that they're living off of these excess savings. But I think there is a lot of things going on, but demographics is one of those things. And I think what happens is we'll see technology speed up in a big way. And a lot of the jobs that are missing now, and a lot of those jobs fall in the service sector for that matter, and service sector is usually lower wage paying. I think a lot of those will be replaced by technology, and we're already starting to see it, but I think that's going to pick up in a big way. And business investment in general has picked up tremendously. And so what that tells me is we're going to see a lot further productivity gains over the next couple years. And I think a lot of that's going to come at the expense of those on the lower end of the service sector type jobs. Yes.
You talked about China, and it sounds like you're tentative as far as the equities. What about the debt side?
Yeah.
Same rationale.
Yeah, I think so. To me, I just think there's better opportunities other places. And that's not to say that China might not do stock equities, might not do exceptionally well. And I think the valuations on them right now say that, hey, this might be a good time to enter. But I just think when there's really no democracy whatsoever, to me, that's a tough environment to invest in. And it's been an okay environment over the last decade or so. But I think what we're really starting to see here is it seems like it's like a paradigm shift in the way that the government is now trying to control the economy. They're moving from this free market to more of this controlled area. And that to me is what's really concerning. So it may be a great area to be in. And obviously, I don't really dive into that too deeply. And so I'm sure there's some really great companies, some really great opportunities. But from an overall perspective, if that can just go away, because they change a rule or something like that, that to me is what's really scary.
Quantify that risk.
Exactly. And that's what's worrisome to me. Yes.
Yeah, that was a great chart you had on.
Oh yeah, good use.
When you quantified it, it sounded like it's going to be a headwind going forward, right? Because we spent so much and that's not paid. So
Yeah.
People talk about that being sure. How durable are those from a purely economic perspective? And then secondly, if we get this $1.8 trillion spending bill, that economically additive, or will the increased tax rates offset that? Economic impact.
Yeah, I think it matters. So for the first part of the question, I agree. I think we will start to see with the massive amount of increase that we've seen in fiscal policy, I think it will start to wane here. I think that's another probably 12 months of really stimulative action that we're seeing. It takes some time to work in the economy, and plus there's more money that still hasn't been spent that will continue to work through. In terms of the new stimulus that could come through, say with an infrastructure plan, I think the actual infrastructure part of that, like the real infrastructure, not the human infrastructure, but the real infrastructure of it, which is not, it's actually a small part of the actual plan. I think that will provide a lot of benefit. I think our bridges, roads, they do need replacing. I think it's something that the government, and it doesn't make sense for a private entity to do that on their own. It's not profitable. We need government to do things like that. And so I think that will be very good for the economy and for the country over the long term. But I think a lot of the other stuff within the program is going to be more than additive. It's going to be inflationary. And I think we're going to start to see further prices. I think it's going to cause more demand in areas that don't need more demand. And we're not going to be able to see supply keep up with the growth that we've seen there. And so I think that's the big concern to me. But I think the bigger concern is, and this is one thing that people always ask is, okay, so the US economy is going to grow this year by, let's just say around 6%, fastest growth that we've seen since the 1980s. Inflation's up, but it's not double digits or anything. So why don't we just continue to spend, because interest rates are so low? We can just add, a couple more $1 trillion, give people handouts again, more stimulus and whatnot, and it's going to drive further consumption, and we're going to see the economy grow rapidly further. And what I'd say is that, well, it is true what we're seeing today is faster growth, but it's at the expense of the future. All we're doing today is we're pulling growth from the future forward to today. Eventually, it has to be paid back. Any economy that's ever tried to grow themselves to prosperity has failed miserably through government spending. Because the only way governments can spend money is by borrowing it or taxing it from essentially the private sector. And so if government spending is very, very high, that means there's less resources available to the private sector. We know that government is nowhere near as efficient as the private sector. And so that's one reason why, yes, in the short term, it can be stimulative, but over the long term, you're allocating resources very inefficiently. And so you start to pay from that with slower growth. And so my big fear over the next 5 years is that I think there's these two things going on. One, I think we're going to be in this massive, on the private sector, this massive productivity boom that we've already seen some of. But I think as technologies continue to roll out here, especially with 5G and artificial intelligence and this Web 3.0, I really do believe it's a new shift that we're making here in productivity. So the real question is, will that growth in private sector and jobs and everything else, will that be enough to offset the massive growth in government? And that's where, I have no idea, but I don't believe that government's going to stop growing. I think it's just going to keep getting bigger and bigger. And so that's the question for me over the next 5 to 10 years. I think personally, we'll see some of the best years that we've ever seen, but that's not to say from a fiscal perspective that there'll be some of the best years that we've ever seen, if that makes sense. Any other questions? Yes.
So I think it's really helpful that you have this valuation pricing models to help you say we're undervalued with the S&P 500. And even then you're being more conservative. You're probably pulling back what earnings are, and you're increasing what discount rates are. I think that drives your roaring 20s 2.0 thesis. Have you tried something that's analogous to that at an international level?
Yeah.
By country, by area. Are there opportunities that you see? I know there's social aspects that maybe you question the numbers, but does that model work?
Yeah, we've never really done it from an international perspective with that model. It's definitely possible to do. It's really not that complicated, but we haven't really broadened it out to other areas. And what we found is that actually, and that's why we use in the United States, what we like about it is we know the data is accurate in terms of corporate profits, especially. We don't use actually S&P 500 profits in our model. We use NIPA profits from the GDP report, which are actually the profits that are reported to the IRS for tax purposes. So we think it's even a conservative measure of profits because most companies aren't reporting more profits profit to the government to get taxed on than they need to, hopefully, if they're smart. And so we think that's a conservative measure, but it definitely could be extended out. I mean, not using our model, obviously, because I've never done that internationally. I think there is value. I think Europe, there's a lot of value in Europe right now, especially if you look at Europe relative to the United States. The valuation's really at almost the cheapest that we've ever seen. And I think they're a little bit behind us in terms of coming out of COVID, where they're not near as open as the United States is yet. And I think once their service sector really starts to open up, you'll see some growth there. And a lot of those companies too are pretty multinational. And so they're getting exposure to the United States and whatnot right now. And then I'd say if you're looking at emerging markets in general, I think emerging markets are going to do pretty well in the next couple of years as well, because not only will they get past COVID, but on top of that, I think commodity prices are here to stay, and commodities are going to continue to rise. And a lot of these economies, especially in emerging markets, are strictly based off of commodities, and how well commodities are doing, so goes their economies. And so I think emerging markets are a good area to be in to tip your toe in. I'd overweight the United States still, but I think having some exposure to Europe and into emerging markets is a good area to be as well. Yes.
How do we get roaring 20s again?
Yeah, I think it really depends. For me, it has everything to do with the consumer, or excuse me, with businesses and the entrepreneur. And so I don't even look really at the debt side that seriously. And the reason too is if you look at from a corporate perspective, corporate debt's at record all-time highs. But as I showed with household debt, I mean, corporate assets are at record highs as well. And corporate assets have grown so much quicker than corporate debt has grown. And so I think debt is a stage that's needed in order to be able to grow and create new stuff, essentially. And I think it's made a lot of sense for corporate cash for companies is sitting at record highs. I think one of the reasons we've seen debt grow so tremendously over this period of time is that it's almost as cheap as cash. So if you can take out debt for very, very low interest rates and lock it in instead of using your cash, why wouldn't you do that? Because you don't know where interest rates are going to be moving forward, except you'd assume, I think most people have assumed, even though it hasn't happened, I think for the last 5 years, most people have assumed they're going to go a lot higher than where they currently are. And so I think that's part of what we're seeing today. But I think what's really important to me is that business investment has really, it looks like it's turned the corner here. And companies are starting to invest in a big way again. You look at business formations right now, and I thought this was a fluke, but if you look back in 2020, business formations skyrocketed. So new businesses that were being started, new LLCs that were being produced. And I thought about this for a little bit, and I came to the conclusion that, maybe something's going on, but I think it's more people wanted the PPP money. And so they're creating businesses and then saying that they don't have any businesses, they're trying to defraud the system. But if you look at where business formations are today, they've continued to grow a lot faster than the historical average. And so I think new companies are coming online that's going to create new employment in industries that really haven't even been started yet. And so to me, I think even though debt's growing, the reason debt's growing is for a positive reason. It's not being used on assets that aren't growing in value. It's not being used on depreciating assets. I think it's being used on assets that are really creating something for the future.
One last question. Can we circle back on emerging markets?
Sure.
Because there's been a lot of talk about them not being able to get the vaccines or rolling the vaccines out. So I feel like there's probably going to be a lag time between when this is actually going to start, going back and returning to some normalcy. Are there pockets of emerging markets you would stay away from based on that, or?
Yeah, it is obviously tough to forecast, but it's a sad thing, but just because a country, an emerging market especially, isn't able to get the vaccine doesn't mean that COVID isn't running through the country in a big way. And what we know from the data is that, a low number of people relative to the population are dying from COVID-19. So you're going to make it out with 99.9% of your population from the data right now, where it's about 0.1% infection fatality rate.
Mm.
But I think in what we've seen from studies so far is that natural immunity is a lot stronger right now than having a vaccine, having those antibodies from actually having COVID. And so I do agree with you, though, that a lot of these countries, it started later and it's starting to work its way through. So I think there will be a lag. But in terms of it being a lag due to a vaccination, I'm not sure. I think it's more important to look at how many cases you're seeing right now in a country. And off the top of my head, I don't know, which countries are further along than other in terms of that. So there's probably something to that. But I think over time, if you have a basket of emerging markets, I think in general that basket's going to continue to grow and do well. And a big reason because I think inflation's here and commodity prices are going to continue to grow.
Okay. Yeah, I was just reading a story about Tanzania.
Yeah.
And they were talking about how they're not, reporting things and,
Yeah.
a
And
lot of
that's
things. So
hard, yeah. India,
just-
it's
right.
gone through a lot of India and it's hard to know, how much because it's hard to report. They don't know
Right.
how to report or whatever. But yeah, completely agree.
Okay. Any other questions? Well, then I think we will end it here.
Yeah,
Strider, thank you
all.
so
It's been a
much.
great pleasure to be with you.
All right.
Thank you.